Hi guys, so today we're going to be looking at one of the key things we look at when we are checking out a Nigerian stock or a US stock. It applies to both of them. The portfolio you see here belongs to one of my students. I'm very proud of it, and before you think I'm selling you my service, no, my classes are free on YouTube. Today we're going to be talking about return on asset. Return on assets basically answers the question, how well is this company using all the assets they have, to make money? Now, when you think of assets, it can be the company's buildings. It can be, if it's a bank, it could be all their ATM machines, wherever they have them. It could be all the money they've loaned out, to customers. It could be all the money they are owed. Basically, all their assets together. How well are they using all those assets to make money? That is what return on assets is. And to basically calculate it, it's net income divided by total assets times 100. We're going to get to that calculation in a bit. Now, for this conversation, I am going to be using GT Bank. If you're looking at GT Bank's return on assets, one of the things you should already ask yourself is all their ATMs, all their office buildings, all their loans they are giving out, all the bonds they've gotten involved with, basically everything, all the assets all together. How much money are they making with everything, right? And you want to calculate this by going all the way back to their full year 2025 report. You see that their total assets are actually around 18 trillion naira. It's a lot of money. It's all their assets together, right? And their net income is around, I think, 800 and something billion naira. I think GT Bank's return on assets is around 4% also, which is really, really good, because bank stocks in Nigeria, their return on assets are usually around 3%, 2%, 1% each. If a bank's return on asset is around 4%, that's actually very good. Now, this is not financial advice. I'm not asking you to go buy GTCO, but it's one of those stocks that if you do these calculations, you realize that their return on assets are actually not bad. Now, if a company's return on asset is not looking good, I wouldn't recommend investing in that company, right? Because it means that all the assets they have, they are not really using those assets to make a lot of money, and that's not good. Now, most people would also look at the ROE, which is return on equity. Return on equity basically answers the question, how well are they using shareholders' money to make money? Basically shareholders' equity. How well are they using it to make money? Now, this one is a bit tricky because your ROE is the way it's calculated is very interesting. A company's ROE can go up because they borrowed money. That's why I pay more attention to return on assets, because ROE can go up easily, and you know what happens when it goes up. It looks like they have money, but meanwhile they don't really have money. So I hope you understand everything I've talked about. If you want a more extensive information on Nigerian stocks and investing, check out my YouTube channel. I'll see you on the next one. Bye.